There is blood in the streets today.
Right.
And I'm not talking about a small trickle. We are looking at a full-blown crisis unfolding in the high-stakes world of biotech. Anavex Life Sciences, AVXL, a name many of you probably know well, is down over 35%. In a single day, it just collapsed from nearly $7 a share to under $4.
It's a market catastrophe, truly. And it's just so devastating because this company's entire reason for being, its whole market cap, was built on the promise of one thing.
One thing.
A potential breakthrough Alzheimer's drug, blarcamazine. And that one single regulatory announcement, a really just devastating one from the European regulator, has erased, roughly $275 million in value.
Overnight.
Just gone.
$275 million, just poof. It's a startling number, and it represents almost a third of the company's valuation just wiped clean. So the core question for you, for anyone watching this, the sheer volatility, is whether this is justified.
Right. Is this it? Is this the end of the road?
Is this the failure we were all worried about, or is this that classic moment Warren Buffett talks about?
Yeah.
Where you should be greedy when others are fearful.
Is this blood in the streets? Is this the time to buy?
That's the question.
Yeah.
And we have to figure out what, if anything, is salvageable here. The market has delivered its verdict, and it's a brutal one.
It is. Failure. For the lead drug in the biggest potential market. So our mission today, our deep dive, is to look past the panic, past the headlines screaming 35% losses.
We have to.
We have to systematically analyze the hard data, the science, which is complex, the CEO's background, which is very specific, the balance sheet, which is critical, and yes, the short interest, which tells a huge story. We need to find the new floor, the real value, and see what the rest of the pipeline is actually worth.
Is the dream really dead?
Or has it just been, put on hold, relocated to a different set of trials?
Okay, we have a ton of ground to cover, because when the market moves this fast, emotion is useless. It's all about the fundamentals and the cold, hard cash.
That's the only thing that matters right now. How long can they survive to fight another day?
Exactly. We need to know their clock.
We're going to break it all down, what the company is, how its management is kind of built for crises like this, and, yeah, most importantly, how many years they have left on that financial clock.
Okay, let's unpack this massive shift in value. Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
Okay, so the very first step, I think, in analyzing any company, but especially one in this much trouble, is you have to define the business model. Because Anavex, well, it operates under some really strict and unforgiving rules.
That's so vital, because when you hear pharmaceuticals, you might think of, I don't know, a giant like Pfizer or Merck.
Right, selling products everywhere.
Exactly, selling established products. Anavex is the complete opposite of that. It's a clinical stage biopharmaceutical company. What does that label actually mean for the risk here?
It means maximum risk. And, maximum potential reward, but also maximum dependence on time and cash. It means they sell 0 products. They have 0 revenue.
0.
And they operate on this simple but incredibly high-stakes loop. They raise money from investors, selling shares. Then they use that cash to fund these incredibly expensive multi-year clinical trials.
And if they succeed?
Success means getting that stamp of approval from the FDA or the EMA. That's the only way they can sell the drug. Or, more likely for a company this size, get bought out by a big pharma player who can handle all the marketing and distribution.
So their entire valuation, the $590 million yesterday, the $315 million today, it's all tied to the potential in that pipeline.
100%. And that potential, well, up until yesterday, it was pretty much all about one product.
Yeah.
Blarcamazine, or Anavex 273. The market saw them as a one-trick pony.
And it's punishing them like one. But if you actually look at their pipeline, that description, it's emotionally true, maybe, but technically it's not quite accurate.
It absolutely is not. The big value driver was, of course, the Alzheimer's program, especially this European application. But if you look at their roadmap, this EU failure is only one piece of the puzzle.
Okay, so what else is there?
Blarcamazine is still in a phase 2-3 trial for Rett syndrome. That's a big one because it has an orphan drug designation. It's also in phase 2 for Parkinson's disease dementia. And they even have other things in the works, like Anavex 371.
So in the span of a day, the whole story of the company has been forced to change. It went from potential Alzheimer's blockbuster to, a specialty neurodegenerative platform.
Correct. And that is the $275 million question the market is trying to answer with this crash. Does the failure in the biggest, most visible market mean the whole scientific platform is compromised? Is the well poisoned?
Let's talk about that platform, because that's their real IP. We hear all the time about the competition, the injectables from Biogen and Eli Lilly. How is blarcamesine different?
There are two massive differences, and both are, well, they're really compelling from a commercial angle. First, there's the convenience.
The convenience mode.
It's huge. Blarcamesine is an oral once-a-day pill. Compare that to the competition, which often requires you to go to a clinic for an IV infusion.
And MRIs, right,
Sure.
to monitor for side effects.
Exactly. Expensive, regular MRIs because of the risk of brain swelling or bleeding. The ease of just taking a pill at home. I mean, that's a massive selling point if the drug works.
But the real moat, the science, that's what the regulators care about. And they're not even trying to do what the others are doing, clearing amyloid plaques.
No, completely different approach. The whole amyloid hypothesis is about clearing out the sticky protein gunk after it's already formed. Anavex is targeting something way further upstream.
The sigma-1 receptor?
Sigma-1, exactly. You can think of it like the cell's maestro, or master regulator. It's deep inside the cell. And the idea is that blarcamesine activates it to restore the cell's balance, its homeostasis. And this is the key part, improve the cell's ability to clean house.
And cleaning house means?
Improving autophagy. It's basically the cell's internal garbage disposal system. In diseases like Alzheimer's, that system breaks down, and all this toxic protein junk builds up and kills the neurons.
So instead of clearing the waste,
You're trying to fix the waste processing plant itself, reboot the whole system so the junk doesn't pile up in the first place. It's a fundamental shift.
that sounds revolutionary, but also, incredibly ambitious. The brain is so complex. How do they try to increase their odds of success?
They use what they call a precision medicine approach. They've been using genomic biomarkers, so specific genetic markers, to try and pick patients who are most likely to respond to this kind of treatment. The theory is if you select your trial population just right, you get a much clearer signal.
Okay, let's play devil's advocate here, because the market is clearly skeptical. Is it possible that this upstream approach, this sigma-1 activation, is actually why it failed?
That's a great question.
If you're targeting the cell's master regulator,
Yeah.
you could be affecting dozens of things at once, and maybe the results just look messy.
That is the core skepticism the shorts have been betting on for years. The CNS is the hardest area in drug development for that exact reason. Regulators want a clean, undeniable statistical win on a primary endpoint. If your drug is affecting inflammation and metabolism and autophagy, the data might look noisy, even if it's doing something helpful.
And the competitive landscape here is just brutal.
Oh, it's a Shark Tank. In Alzheimer's, you're up against the biggest players in the world, Biogen, Eli Lilly, Roche. And even in the smaller Rett syndrome space, they're still facing Neuron and Novartis. It's not an easy path.
Which brings us back to the great filter, that regulatory barrier. The failure rate for Alzheimer's drugs is, what, over 99%?
That number says it all. The regulators are incredibly tough because the brain is so delicate. Getting it wrong has massive consequences.
And that filter just slammed shut on Anavex. Let's detail the crisis event. What was the news on November 14th that cratered the stock?
The European Medicines Agency's CHMP, that's the Committee for Medicinal Products for Human Use, they issued what's called a negative trend vote on blarcamesine's marketing application.
A negative trend vote.
It's not the final official no that's expected in December, but functionally, it's a rejection. It means the panel of experts looked at all the data Anavex submitted and said, nope, the benefit-risk profile isn't good enough for Europe.
A devastating blow. But management's immediate reaction, that was a masterclass in crisis PR. They didn't just apologize.
Not at all. And this is where having a finance guy as CEO, not a pure scientist, really shows its value for survival.
Okay.
They announced two things in the very same press release. First, they requested a re-examination, which is like an appeal process. It's a total long shot, a Hail Mary. But it keeps the story alive that the European door isn't completely 100% slammed shut.
And the second thing was a real strategic pivot, the one aimed squarely at the U.S. market.
Exactly. In the same breath, they announced that the FDA had advised them to request a meeting to discuss their U.S. trial results. And just like that, the narrative shifts from European failure to American opportunity.
That's brilliant.
It gives their retail investor base, which is huge, a new positive catalyst to hang on to. It's a savvy way to manage a catastrophe.
And it buys them time, which is essential because the barriers to entry here are still just astronomical.
Absolutely. The question now is whether the management is equipped to actually navigate that even tougher FDA process, especially after the EMA raised such a huge red flag.
Speaking of management, let's pivot to the person steering this ship. Chapter 2, Management Evaluation.
All right, so like we were saying, a pre-revenue company like this is really ruled by its CEO. In this case, that's Dr. Christopher Missling. And his profile is just essential to understanding how this company operates and how it's responding to this crisis.
And the key thing here, the insight, is that he's not a research scientist by trade.
Not at all. He is a financial engineer, a capital allocator. His background is in investment banking at Deutsche Bank, and he was the CFO at other biotechs. This is not a guy who spent his life at a lab bench. This is a guy who spent his life in spreadsheets and boardrooms.
I have to challenge that a little. For an R&D company, isn't that a massive red flag? If your CEO is all about finance, isn't he maybe incentivized to, I don't know, run cheaper trials that look good on paper but aren't scientifically rigorous enough for the FDA?
That is a fair and I'd say an essential critique. And it's why a lot of professional investors have been skeptical. A CEO focused on the balance sheet can absolutely be tempted to prioritize the stock price and cash runway over trial rigor.
Yeah.
But for a company with zero revenue, the CEO's #1 job isn't running the lab, it's making sure there's money to fund the lab. Dr. Missling's financial skill is the entire reason Anavex has that fortress balance sheet we're about to discuss. Zero debt, lots of cash. He kept them alive.
So his skill set might be the only thing that saves them now, even if there are questions about the science. And we saw that skill in action with the CHMP vote response.
Absolutely.
Yeah.
That CHMP failure FDA pivot was textbook. It was designed to appeal directly to their main shareholder base, 60% retail investors who trade on hope in catalysts. By injecting that FDA meeting news, he gave them a new story.
A new hope.
Exactly. And it prevented an even worse panic sell-off.
Okay, let's look at how he allocates capital. Where does the money actually go?
It's going to the right place. In the last quarter, R&D spending was $10 million. General and administrative, salaries, legal fees was $4.5 million. That ratio, favoring R&D by more than 2 to 1, is exactly what you want to see at this stage.
All the money is going back into the research.
As it should be. They're not doing stock buybacks or paying dividends.
Which would be insane.
It would be wildly irresponsible. Their only duty right now is to preserve every single dollar to fund the Rett and Parkinson's trials and get ready for that big FDA meeting.
And his compensation.
It's pretty typical for the sector. An $800,000 base salary, bonus potential. It sounds high for a zero-revenue company, but it's competitive. And importantly, a huge chunk of his compensation is tied up in stock options, so his personal wealth is directly linked to the success of blarcamesine.
He feels this 35% drop personally.
Oh, absolutely, which is a powerful incentive.
Okay, and we have to touch on this misleading metric. The company's return on invested capital, or ROIC, is negative 41%. Why is that number basically useless here?
It's useless because ROIC is for mature, profitable companies.
Yeah.
For a clinical stage biotech, a negative ROIC isn't just expected, it's literally the definition of their business model.
Right.
They are investing massive amounts of capital now for a potential payoff years down the road. The fact that their losses got bigger as they went into phase 3 trials was actually a sign of progress until the regulator said no. The only metrics that matter are cash runway and R&D productivity.
Okay, so the business is binary, the CEO is a savvy financial operator, and the science is complicated. Now for the lifeline. The money. This is really the only comfort in the story today. Chapter 3. Financial health.
This right here is the absolute core of the deep dive. When the science gets a black eye, the balance sheet becomes your only margin of safety. This is what separates a company facing a setback from one facing bankruptcy.
And the catastrophe is just so clear in the market cap. We know there are about 85 million shares. Yesterday, the market valued all that potential at roughly $590 million.
And today, at that crisis price of $3.69, the new market cap is just over $315 million.
So that loss, $275 million, that's the market quantifying its loss of faith in the European Alzheimer's opportunity.
In a single day, it's a stunning amount of value to just evaporate.
And again, let's stress the reality here.
Yeah.
Zero revenue,
Yeah.
and all their margins are negative.
By design. They expected to burn through about $13 million last quarter alone. And that burn rate is actually going up because phase 3 trials are exponentially more expensive than the early stages.
But this is where Dr. Missling's financial background pays off, the fortress balance sheet.
It's truly exceptional capital management for a company like this. First, and this is the most important part, they have zero debt.
Zero.
In an environment with high interest rates where debt is just crushing so many other companies, Anavex is completely unburdened. They're not paying interest, they're paying scientists. That freedom is monumental right now.
And their ability to pay their short-term bills.
It's incredibly strong. Their current ratio is 6.74.
And what does that mean?
It means they have almost $7 in liquid assets for every $1 bills they have coming due. A ratio of 2 is considered safe, so they are nowhere near a liquidity crisis.
Which brings us to the ultimate survival metric, the cash runway. How long can they keep the lights on and fund the remaining trials without having to go back to the market for more money?
This is the real margin of safety for anyone thinking of buying this dip. You look at their cash on hand, which was $101.2 million. Then you calculate the burn rate. Over the last 9 months, they burned through about $31 million. So that averages out to roughly $10.3 million per quarter.
Okay, so let's do the math for everyone listening. Cash divided by burn rate.
101.2 million divided by 10.3 million per quarter. That gives you about 9.8 quarters, so 2.5 years.
2.5 years of runway.
In management, they're often a bit conservative. They say they have more than 3 years. But even if you take our more conservative number, 2.5 years is a very, very long time in biotech.
Okay.
The key takeaway is simple. Anavex is not going bankrupt anytime soon.
Okay.
They have the time to pivot, to analyze what went wrong, to execute on this FDA meeting strategy, and to finish the Rett syndrome program.
Time is literally the most valuable thing they have right now.
It buys them a chance to be right.
So how do we value this company now? PE is useless. The old models are in the trash. How do you value a collection of ideas with a pile of cash?
You have to shift your methodology completely. You move from that complex, risk-adjusted net present value model to a simple sum of the parts analysis. And the foundation of that is the cash.
Okay, so what's the new valuation floor?
The floor, the absolute bedrock value, is the cash per share. You take the $101.2 million in cash, you divide it by the 85.4 million shares.
And that gives you?
$1.18 per share. Rationally, the stock should not trade below that level because that's the liquidation value.
But the stock is trading at $3.69. So that difference, that's what the market is paying for the remaining potential.
That's the stub value. $3.69 minus the $1.18 cash floor is $2.51 per share. Or if you look at the enterprise value, which is market cap minus cash, it's about $214 million.
And this is the central question for any investor today, right? The $214 million debate.
Exactly.
Is the entire remaining pipeline, the FDA shot, the Rett program, the Parkinson's program, is all of that worth $214 million, or $2.51 a share?
That is the ultimate test of the blood in the streets thesis. We are no longer debating a multi-billion-dollar Alzheimer's cure. We're debating if this technology platform, with 3 years of funding, is worth just over $200 million today.
And that answer really hinges on market sentiment, which is where we're going next. And as we dig into this critical debate on remaining value, a quick reminder, like and subscribe to Stock Analytics AI, Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Right, so to understand a crash like this, you have to understand just the wild disconnect that existed between the dream and the reality.
Let's start with the dream. Before this CHMP vote, what were analysts saying?
The average analyst price target was a staggering $44, a consensus strong buy.
$44.
$44 compared to today's price of $3.69.
That's not just a drop, that's a different universe.
It's over 1,000% difference. What this tells you is that the analysts were pricing it in full 100% success. Their models just got vaporized. It's a huge lesson. Analyst reports in this sector are often just selling the company's best case story.
44 versus 369. That's a total reevaluation of the science. So let's look at the investors who got this right. The skeptics, the people who bet against the company. The smoking gun here is the short interest.
This is, without a doubt, the most important psychological data point in this whole deep dive. 32.12% of the float is short.
32%. That's not just skepticism.
Yeah.
It is a declaration of war. What does that astronomically high number tell you about the smart money consensus?
It tells you that a huge, very informed group of specialist hedge funds and professional short sellers looked at the exact same clinical data that Anavex was presenting as positive, and they concluded months ago that the data was weak, that it was noisy, and that it would probably fail regulatory review. They placed massive, calculated bets on this exact outcome. And today, they made an absolute fortune.
This also explains the violence of the drop. The longs panicked and sold, and the shorts were proven right, creating a feedback loop.
Exactly. High short interest creates this extreme polarization. Any good news can cause a massive short squeeze, but any bad news, like this, leads to an instant, brutal collapse.
And the media tone today is just reflecting that crisis.
Oh, the headlines are all about the catastrophe, the collapse, and technically, the stock chart confirms a complete breakdown. The price is so far below its key moving averages, it's a classic death cross pattern. The trend is broken.
This extreme polarization, the high analyst targets, the massive short interest, it all comes down to who actually owns this company. Chapter 5. Ownership structure.
Yeah, the ownership structure really dictates how a stock behaves, its volatility. And our analysis shows that an estimated 60% of Anavex is owned by the general public, retail investors.
60%. That's a huge number for a company this size. Why does that matter so much, especially in a crisis like this?
It is the primary engine of volatility. Retail investors are drawn to story stocks, the dream of curing Alzheimer's.
Right.
They often trade on momentum, on headlines, on hope, not on deep balance sheet analysis. So that high concentration is what fuels those crazy hype targets like $44. But it also leads to the massive, instantaneous 35% panic sell we saw today.
So what about the institutions? The so-called dumb money versus smart money?
Well, only about 37% is held by institutions, but if you look closer, the top holders are passive index funds. Vanguard, the SPDR S&P Biotech ETF. Yeah, the XBI, exactly. They are the definition of dumb money in this specific case. They don't own Anavex because they believe in the science. They own it because they have to. It's in the index they track. They can't just sell because of bad news.
Which means the retail investors and the short sellers have even more power to swing the price.
Disproportionate power, yes. But conversely, the active or smart money institutions, they were sending a terrifying signal months ago.
They were selling.
They were getting out. Informed funds that do their own deep diligence, like Invesco and Millennium Management, they sold 100% of their positions in the last 2 quarters.
Wow.
This institutional exodus completely confirms the skepticism that was driving that high short interest. They saw the same flaws the CHMP eventually saw and got out before the hammer dropped.
What about insiders? Did Dr. Missling or other execs sell?
We don't see any evidence of public panic selling. Ms. Nelling still holds about 1.5 million shares. Recent transactions were mostly just routine option exercises. But on the flip side, we also haven't seen him step up and do any huge open market buys to signal that he thinks the stock is cheap.
So a neutral signal from insiders.
Essentially, yeah.
Okay, so we've got a scientifically complex company, no revenue, a strong balance sheet, but a huge regulatory failure, fueled by retail enthusiasm and massive institutional skepticism. Let's put this all together in a risk framework. Chapter 6, Risk Assessment.
Okay, let's use the classic SWOT analysis here. Strengths, weaknesses, opportunities, and threats. It's the best way to separate what's left from what's been lost.
Let's start with strengths, because right now the only thing keeping this company from being a zero is its financial position.
Exactly. Strength number 1 is the financial fortress. $101 million in cash, 0 debt, and a runway of at least 2.5, maybe 3 years. They are completely insulated from the high interest rate environment that's just killing other biotechs.
Time.
It buys them time. Strength number 2 is the differentiated science. The sigma-1 mechanism is still unique. It's not tied to the failed amyloid hypothesis. So if the CHMP failure was about a flawed trial design and not a flawed drug, the science itself might still be valid.
And strength number 3 is the rest of the pipeline.
Right. The Rett syndrome program is still active. It has that orphan drug designation, which gives it a faster, easier regulatory path and market exclusivity. That program is still very valuable, and it's totally separate from the Alzheimer's outcome.
Okay, now for the weaknesses. The big one is obvious. The binary risk just hit.
It hit hard. The lead drug failed in the biggest market. That just crushes the valuation ceiling, and it makes everyone question the credibility of the whole platform. And we have to remember their cash dependence. After 3 years, if they don't have a win, they have to go back to the markets for more money.
And the volatile ownership base.
The 60% retail ownership just creates constant instability.
So what are the opportunities left? Seems like the entire bull case now rests on the U.S. pivot and that RED program.
That's it. The FDA path is the #1 near-term opportunity. That press release announcing the FDA advised them to request a meeting is critical. If they can go to that meeting, present their biomarker data, and convince the FDA there's a path forward in the U.S., that changes everything.
And the second opportunity is a renewed focus on the pipeline.
Exactly. A win in the Rett syndrome program can't be understated. The market is smaller than Alzheimer's, but the regulatory path is easier, and the pricing power is immense. The deep value thesis is that at a $214 million enterprise value, you're getting a fully funded platform with multiple shots on goal for way too cheap.
Now for the threats. The biggest one has to be regulatory contagion.
This is the existential risk. The CHMP saw something they didn't like in the data. The biggest threat is that the FDA does their own analysis, agrees with the CHMP, and shuts down the U.S. path completely. If that happens, the Alzheimer's dream is truly over.
Yeah, and the army of shorts you mentioned.
They are emboldened now. They won the first battle. They will keep betting on the stock bleeding down to its cash floor, so any rally is going to face heavy selling pressure.
And finally, the macro threat that hangs over all of biotech, interest rates.
High rates are brutal for cash-burning companies. Anavex is safe for the next 3 years, thanks to their balance sheet, but that clock is ticking. If they don't have a win by 2028, raising new money will be incredibly difficult and very, very painful for shareholders.
And just to dismiss it, we see headlines about U.S. tariffs on pharma. For Anavex, that's a non-issue.
Total non-issue. It's a distraction. They don't have a product. They don't have revenue. They don't have a global supply chain. It's completely irrelevant to their real existential threats.
So the SWOT is clear. The cash buys them time. The FDA meeting and the RET trial are the only real hopes left. Chapter 7. Conclusion.
All right, let's put it all together and really lay out the two opposing arguments that are driving all this volatility today.
What is the fundamental bull case?
Yeah.
The blood in the streets argument.
The bull case is all about a massive overreaction. They argue the market threw the baby out with the bathwater. The EU failure doesn't automatically kill the U.S. opportunity, and it certainly doesn't kill the funded RET program. They'll say that at a $214 million enterprise value, for a company with zero debt and over $100 million in cash, you are getting a patented, funded technology platform for a ridiculously cheap price.
The bear case, on the other hand, is much simpler, more cynical.
The bear case says the smart money was right all along. The shorts, the institutions that sold, they saw the flaws in the data. The regulator just confirmed those flaws. The company is now a zombie. It has enough cash to stay alive for a while, but the science is broken.
So the stock will just bleed out.
It will slowly deflate towards its $1.18 cash floor as the money runs out, and the other trials also prove to be inconclusive.
Okay, so let's restate the valuation range. The old models are dead. Where does the stock actually stand today?
I call it no man's land. It's caught between extremes. The absolute floor is $1.18 in cash. The current price is $3.69, and the previous dream was $44.
So the current price is a brutal but maybe rational repricing. It's pricing in about $2.51 of future potential.
Right. This is no longer a high-growth blockbuster story. It's a deep value turnaround play, and it depends completely on flawless execution from here on out.
So the whole thesis now rests on just two things.
Two pillars, and you have to believe in both. The $101 million in cash, which provides the time, and the upcoming FDA meeting, which provides the one remaining big-ticket catalyst. If that FDA meeting goes badly, that $2.51 of stub value evaporates, and the stock will trade much, much closer to cash.
This has been a really comprehensive breakdown of a company at its absolute most critical moment. The market has spoken, but the final chapter isn't written yet.
Before we sign off, here's a final thought for you to consider. If that $2.51 stub value now has to be justified only by the Rett syndrome program and the smaller Parkinson's indication, is that still too high? Or is the market so focused on the Alzheimer's failure that it's completely ignoring the advantages of the orphan drug path? Is it assuming the whole science is poisoned, when in fact these smaller, cleaner trials might be exactly where this drug could succeed? That's the real calculation of value today.
That's the kind of critical, numbers-driven thinking you need to navigate this kind of volatility. When the dreams fade, cash is the only margin of safety. And Anavex has bought itself some time to fight another day. Like and subscribe to Stock Analytics AI.
For $45.99 month, get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
You've been listening to The Deep Dive. Remember to subscribe. This analysis was generated by an AI system for educational purposes only and should not be considered financial advice. Please conduct your own research or consult a qualified financial advisor.